Good morning, everybody. Congratulations on Tesla hitting a new record with 12 consecutive green days. I think today's going to make it 13 days. It's going to be a very interesting day as we just got CPI information that came out, and it's actually really good news. And I think a lot of the people on CNBC, Bloomberg, everything are kind of underplaying what is happening. So we're going to take a look at this, and I'm going to kind of explain why I think Tesla and tech in general are set to continue this rally. Why I think the Fed is more than likely done. Why I don't think we'll get a rate hike in July. And with that said, let's just get right into it. All right. So first thing, what happened today? Well, we got a read of 0.1% month over month inflation, and zero point 0.1 was for May, right? So in this chart here that you can see, you can't quite see the zero point 0.1 yet because this hasn't been updated, but that will be the next number that comes in here. So you can see we have April here. And again, remember, we're in June, so we're looking at May's data, right? It lags a month. So where were we at last May? Okay, well, last May, we were at 1.1% month over month, which you can see here. Let me just make sure you guys can see that. Yep, 1.1 over here. Um, and we were at 8.6 over the year, right? So in other words, the last 12 months added up of these month over month numbers, add up those 12 months, that gives you your year over year. And this is the big number that you're seeing all over the 4% right now. That's these numbers here. So we see that this 1.1 got replaced by a zero point 0.1. Don't forget, next month is a big deal because next month we're going to be lapping over a 1.4. So if that also comes in at zero point 0.1, that's going to be huge. Okay. That will take a huge part out of this. We will, without a doubt, be in the sub threes. All right. So with that said, we are now at 4%. Okay. So we were at 4.9%. We've come down to 4%. Now, what you're going to hear nonstop all day is about core inflation and why core inflation is still sticky, and this is why the Fed's got to do more work, yada yada yada. So, what are they saying? Is this real? Is this FUD? Is there a validity to what they're saying? Okay, there is validity to what they're saying. I think if you're going to be very shallow in the conversation. And so, and again, this is just my opinion. All right. What do I know? Do your own research. Come up with your own opinions. Take this as a data point. My opinion is if you're going to be shallow about CPI, you're going to look at core and you're going to say, well, that's the reason why they're going to keep on raising rates because the core isn't down. Core has been coming down. Core has been steadily at zero point 0.4 for the last, I think, 5 out of 6 inflation reports. Now, that isn't enough to get down to what makes the Fed happy, but the truth is they have a Fed mandate of getting to 2% for inflation, not to get core to 2%, to get inflation to 2%. We are now at 4%. Core stuck at 5.3%. Did it come down? Yes, it did. Did it come down as much as people expected? No, right? So I think the expectation was 5.2. It came in at 5.3%. So, what is core? Well, core is essentially CPI, but you take out energy and you take out food, with the thought that those are two volatile aspects of inflation. So, they're more likely to come down. And so, it kind of doesn't give you a true perception of what is happening. So let's go ahead and look at the actual report, and I think we can get a little deeper in our understanding. And by getting a little deeper, it'll allow us to make better decisions moving forward with regards to what's possibly going to happen in the market. So here it is. I went through this already this morning for you guys, and I want to just kind of give you the highlights here. Okay, so index for shelter was the largest contributor to the monthly all-time or all items increase, followed by an increase in index for used cars and trucks. So in other words, with CPI, and again, if you exclude energy and food, so core has housing, has used vehicles. Those were the main parts of the inflation, right? That's where we saw most of it. Let's keep reading. The index for all items less food and energy, in other words, core, rose at 0.4% in May, as we discussed, as it did in April and in March. Again, we already covered that. Indexes, which increased in May, include shelter, used cars and trucks, motor vehicle insurance, apparel, and personal care. All right, let's talk about Tesla real quick. So this is amazing. So used cars prices are going up. Why? Well, because people think that, or people aren't buying new cars, right? So supply demand, right? Just pretty basic. And not just that, but there's a lot of good YouTubers out there doing a lot of good work, and they're essentially showing us that these new vehicles going on to dealership lots aren't being sold, and so they're going to auction. So that gets classified as a used vehicle. So that's very interesting. But for Tesla, this is a good sign, right? This is yet another data point that shows that you've seen the auto market slow across the world, yet Tesla is crushing it. In fact, they just crushed it with their China numbers for this last week. Okay, so then what's the other part here? Speaking of Tesla, motor vehicle insurance. Motor vehicle insurance, right? Tesla gives you the best premium for your vehicle insurance, right? They have the best data. They can give you real time numbers, and it's really up to you. The power's in your hands on if you want your car rates to go up or down when it comes to insurance. So then the other part of this is apparel, personal care, and shelter. Okay, shelter. We're going to touch on that more, but apparel and personal care. Listen, I do not think that the Fed is going to raise rates because clothes are more expensive. Don't think so. All right. So here we can see the breakdown. You can see the month over month. You can see the unadjusted 12-month ended May 2023. Let me grab a sip of coffee here. It's really early where I'm at, so pardon me if I'm a little rough. All right, let's scroll down here to some more important stuff. The shelter index increased 0.6% over the month after rising 0.4% in April. So shelter is rising still, all right, despite everything we see. And even though shelter is rising, this will be one of the reasons why the Fed will not raise rates. I'll explain in a second, okay? And this is why I'm so bullish for tech right now, because the Fed's done, in my opinion. We'll make different thoughts or calls or predictions as we get more data. But right now, with all the data I have, the Fed's done. They are absolutely done. Raising rates will not help. Okay, let's continue and I'll explain. The shelter index was the largest factor in the monthly increase in the index for all items less food and energy. Again, core, that's core, right? So shelter was the largest factor in the monthly increase for core inflation. Among the other indexes that rose in May was the index for used cars and trucks, which increased 4.4%, and the index for motor vehicle insurance, which increased 2%. Again, 4.4% for used vehicles. It actually did that same number last month. All right, so used vehicle prices are actually going up. All right, let's go down here. The shelter index increased 8% over the last year. So shelter prices are up 8% over the last year, accounting for over 60% of the total increase in all items less food and energy. In other words, this core inflation that you're going to see all over CNBC, all over Bloomberg, everybody's like freaking out about, that core inflation, right? 60% of that is coming from shelter. All right. Yet I keep saying that the Fed will not raise rates anymore because raising rates will not solve this problem with shelter. Okay. So what am I talking about? Let's see. Did I highlight anything else? No, that's it. Okay. So what am I talking about? All right. This, and I could be wrong. I have no problem being wrong, but this is my thoughts, my opinion, my logic. Why are shelter prices rising? Well, I think it's pretty basic. You have, and remember, shelter is not just rent. Okay, it's rent and it's houses being sold and it's and houses being built, right? It's all that kind of like conglomerated into one aggregate of shelter. So why won't the Fed raise rates? Why won't raising rates help shelter? This is pretty basic understanding, right? Like keep it simple, stupid, right? The KISS method. You don't have to be a rocket scientist to understand this. Right now, you have people like myself, like you probably, many people in the United States that have houses, have mortgages, 30-year fixed rates at sub 3, 3, maybe in 4, mid 4s, and they are not willing to depart from those low interest rates to get into a 6, 7 plus mortgage interest rate. It makes no sense, right? So people like all of us are not willing to sell our houses just to get into a higher debt, to be able to go and buy less house than what we currently have. Makes no sense. Stupid. Why would you do it? Right? It financially, it makes zero sense. Okay. So think about that. So what does that mean? Okay, well, that means that when people are out there wanting to buy a house, when people are in the market and are ready to buy a house, well, guess what? Supply is down. There is not enough supply right now. Supply is way down. Home builders can't keep up. Even if they did, it's going to be even more expensive than a used house, if you will. And people like us are not willing to sell our houses to get into where are we going to move? Where are we going to live? Right? I mean, to do what? To go pay more for less? That makes no sense. Okay. So if less people are willing to sell, and remember, this is peak. This is the time. This is the time to be selling or buying houses. This is the time period. This is the season, right? School's out. This is when people want to do it. So if if that's the case, and there's less supply coming onto the market, and buyers are still out there, that means we have an issue of supply and demand. So if supply is down, demand's up. Well, what does that mean? Right? That means that houses that are on the market are going to hold their value. They're going to be worth more. They're going to be able to raise prices. And as they come on the market, they're going to be able to ask for more because there's only so much supply and demand is outstripping supply. Okay, so then what happens? Well, then what happens is a lot of people won't find what they want and they aren't willing to go and pay $1 million at a 7% rate for some crappy 1,300 square foot house that they're gonna have to tear down because it has two bedrooms, one bath that barely works, and that extra bedroom is really like a closet, or that they just put another closet into it to call a bedroom, right? So it's just garbage. And you're seeing that everywhere. And so those people that would be buying are deciding to go to the rental market. Well, then what happens? Well, now you have a flood of people going to the rental markets, which will help increase or which will drive the amount of people that want to rent. And so that means that demand for rent go up for rentals, right? So demand for rentals go up. If demand for housing goes up, supply for housing for buying purchase for new houses is down. And now all those people flood into the rental market and there's not enough rentals out there. What do you think is going to happen? Prices are going to get jacked up. And what's going to stop this? Will raising rates fix this problem? No. No, it won't. It will not. Raising rates will have less people deciding to sell their houses because they don't want to sell their house to go into another house at a higher interest rate, right? So it becomes this disgusting flywheel effect, right? So I think the Fed's done because if 60% of this core inflation that everyone's saying is bad is coming from shelter, raising rates will not fix that. It will not fix that. Okay. The only way to fix that is by cutting rates. Because if you cut rates, then more people are willing to put their houses on the market, right? You stimulate the supply out there. So we're in a weird inflection point, right? So the other thing that's really exciting with regards to this is that next month we're going to be lapping a 1.4% increase month over month number. And this month we saw 0.1%. That means there's a chance next month we see 0.1. Maybe we even see zero. Who knows? Maybe we see a negative percent, right? Because if you look around, right, you look at all the signals, it does show that the economy is slowing. Look at oil. The Saudis, the OPEC, they cut oil production, yet oil continued to fall. Why would that happen? Was it because Tesla? Yeah, maybe a little bit. Maybe it's electric vehicle movement, but I think it's a sign, a clear sign that demand is slowing. Economic growth is slowing. And so this will have a lagging effect on the economy. Now, I still think we have housing shelter lags that are going on that we will see that come through the numbers. I think we will see cars price start to come down eventually. But again, it's the same thing. If people aren't going to buy that new house and they're not going to be able to get what they want, well, the next thing that they'll go to get that kind of feeling of like, well, I want to treat myself. I can't afford a house. I make all this money. I work hard for this. I need to at least treat myself somehow. So what do? Well, I'm going to go buy a car. Right. So again, this high rate thing is going to start plaguing all these different areas because you're at such a high rate. especially when we're in such a strong economy, right? We are in a very strong economy right now that can sustain everything that's going on. Ideally for the Fed, you raise rates, huge layoffs, market gets sent crashing, everything kind of corrects. We're not, that's not really what we're seeing here. But we are starting to see some weakness in job numbers. We are starting to see some higher claims for unemployment. So from a Fed perspective, that could be a good thing. In my opinion, stop it. Just stop it. Hold where you're at. Stop raising rates. You have the win. You win. You won. Fed, you won. Stop it. Okay, you've won. All you have to do is chill out, sit, and stand still. All right. As we know, rates work with varied and lag effects. We see inflation coming down. Is it not coming down as fast as you want? Well, okay, we are at 4%. We're going to be in the 3% next month. Guarantee we'll be at 3% next month. Mark my words, okay? Clip this out if you want. We'll be there. We'll be in the 3% next month. Core, okay, core is not coming down as fast as you want. But now aren't we nitpicking? Right now, now it has to be core that has to be down. Now it's core that we need. Okay, well, is it coming down? Yes. Is it coming down as fast as you want? Maybe not. Okay, but we are seeing progress. All the Fed has to do is shut up, sit tight, and don't do anything. You can have a soft landing if you just stick it out. You can have a soft landing where you don't look as stupid as you did before by waiting too long and calling inflation transitory. You can have a soft landing with the good jobs market, and you can look like the hero. You can redeem your reputation. All right. And I think at this point, that's what they care a lot about. So we're going to see tomorrow a pause in rate hikes. We're going to see a lot of hawkish talk about there's still more work to be done, sticky inflation. We're going to hear things about shelter. So we're going to hear a lot of this rhetoric, but they're not going to raise rates tomorrow. I think based on the data we have today, this data can change in a week from now, next month. But based on the data and information we have right now, I think they're done raising rates. I think we'll see a cut early next year, and we'll see what happens. But I'm gonna leave it there. I hope you guys have a great morning. Go kick ass in your day. Work hard. Be focused. Enjoy your family. And yeah, I'll tell you guys later. Peace.